Hello, everyone. This is Shane with Trade ATS. You guys kind of know the drill at this point. Before we get started, could some of you go ahead and type a Y into the chat if you can hear me all right? All right, beautiful. So we've got a pretty exciting little webinar plan today. Sorry about the little delay to get started. We've got a lesson that Wade's going to be going through. It's focusing on multi-time frame analysis and some of the clues that you can look at in it, and trying to figure out directional bias and all that fun stuff. So we're going to go through that, and as a little bit of housekeeping for those of you, this might be your first time on, this is more going to be trading focused, and as far as technical support or anything like that, try and keep that to support@tradeats.com. Just go ahead and send over any of your issues that you're having there. um, Quick announcement, we are not going to be having a webinar next week or the following just because of Christmas and then the new year. I'm sure a lot of you that have been trading for a little while know that's it's not exactly the best trading environment to be in. So we're going to do that, and then we've got a lot of new stuff planned that we're planning on releasing within the first week or two of the new year. So just some of the stuff that we've been previewing with you guys here lately and everything. So all that being said, I'm going to go ahead and hand it over to Wade. And if any of you have any questions or want some info, go ahead and I'll be in the chat replying to some of your questions. Thanks.
All right, thank you, Shane. I want to welcome everyone to this week's webinar. Again, we apologize for getting started a little bit late, just trying to get everything set up here. Can you guys just give me a quick sound check? Let me know you can see and you can hear before I start going off here. A simple Y would work. All right, I see some Y's coming through. Thank you very much. Okay, so like Shane said, we've been working on, if you guys have gone back and watched some of the recordings, by the way, I did see someone ask, will the recording be available? The recorded webinars are in the online course. It's like the first or second, or it's like, I think the second lesson when you log into the online course, there's a webinar section. And if you click in that, then it'll have links to all the old webinars that are on YouTube. They're private, it's to a private link. We don't have them up publicly, but you guys will be able to go on YouTube and actually check those out. So what we've been trying to do is put together kind of just different PowerPoint presentations and things on different subjects, and then preview those with you guys to kind of test the water with them and kind of see how they go, and then make any changes necessary. And so what we're trying to pull off is we're trying to have like one subject that we feel is extremely important in trading, and we're trying to go deep on that one subject. In this week, if you watch the other webinars, you see that we covered boxes, we covered expansion lines, we covered liquidity lines. This week we're going to cover something. It's not a technical component of the software like that is, but it's a very important part of our trading, which is multi-time frame analysis, or time frames in general. So, and also too, a little disclaimer, I finished this webinar mostly last night at about midnight. It's burning the midnight oil, so I apologize if there may be some misspellings and things like that. I went over it several times, but sometimes I gotta do it more than that to get everything right. So give me a break if there's some misspellings. I apologize. I'll get it right though. So what we're going to cover today are, why are timeframes important to trading? What do different timeframes represent in real-world trading? And how can we use timeframes to predict market moves? Okay, so let's get into the material. Why are timeframes important? So all relevant market information is represented through timeframes on a chart. Okay, everything is cooked into the price action. We can't argue with the price. regardless of what our beliefs and our analysis is going into the next comment here. Regardless of news predictions, general fundamentals, the price action represented through chart timeframes is the bottom line of all markets. That is, it is what happened. It is the sensitive price levels, even just going to basic support and resistance, highs and lows. No one can doubt that those are sensitive levels. So inside timeframes, and the price action within those timeframes, in my opinion, is the most accurate view you can get in staying in tune with where the markets are headed. It's a heavily technical approach. And I'm not saying don't look at fundamentals. You can use fundamentals as an overall backdrop to your analysis, just understanding, kind of what's overall behind what's going on. But at the end of the day, your entries and exits, the risk to reward ratio, and those calculations are all going to be based on technicals if you're going to want to really manage and make the most out of your positions. So by accurately understanding the forces behind different timescales and markets, you can begin to anticipate the possible intensity and follow through of different opportunities. So what we mean by that is by understanding the money and the different traders' plans behind the timescales that they are using to trade. When you understand who's behind what, then you start to understand what the possible follow through is, mostly when it comes to trends. We want to know if there's money behind a trend, it's gonna hopefully keep pushing, and we need those trends to continue to actually to make consistent profits. So this understanding leads to one of the biggest edges you can have in trading. Again, this is my opinion. I think multi-time frame analysis, regardless of software or whatever, just if you guys have a big grasp on understanding time frames and the swing of time frames and the general market direction, I think that's one of the best things that you can learn. Like I said, regardless of using ATS or whatever, just simply being able to pull up one or two charts of the same currency pair in different time frames and being able to extract information out of that in a meaningful way is one of the best skills you could build. So, and like I said, I think it leads to one of the biggest edges. If you combine other things like ATS with that skill, then it's a pretty awesome combination. So we're going to talk about the scale of time frame interest. Okay. So right here we have a list of time frames. We start on the left. We got the 1 minute, the 5 minute, the 15 minute, to the 30, the hour, then the 4 hour, the daily, weekly, and monthly goes to the bigger time frames that most people are going to look at when it comes to trading. So on the left, you see that we have fast, small money. Okay, so fast, small money is going to be traders that are trading relatively low amounts of money. And when I say low, I'm not saying it might be low for you. If you're trading 100 or 200 bucks a pip, 20 lots, 30 lots, that's going to be significant for you. But in the world of Forex, moving money, international business, that's nothing. So when I talk about fast, small money, we're going to be talking about more high frequency, in and out of the market, people trading within the New York, London sessions when it comes to Forex. Slow, big money, we're talking about the actual money that moves the daily, weekly, monthly trends. So I'm actually kind of getting ahead of myself, but hopefully you guys get, I'm going to go into that deeper here, but you guys understand, we got fast, small money that interacts on those really fast, quick swings you see on the 1 minute, 5 minute, 15 minute, and then the slow, big money that interacts on the hour, 4 hour, daily, weekly, monthly time frame. Okay. So who is fast, small money? So this category includes the majority of retail traders using high frequency, short-term trading systems and strategies. And when I say high frequency, I'm not talking about like the crazy server rooms that are next to the stock exchanges. That's a whole different thing. When I talk about high frequency, I mean just actively trading, 10 positions, 15 positions in a morning, possibly. So short-term trading systems and strategies, are mostly going to fall under retail traders that are getting in, maybe people that are new to trading and just want to get in and try to rip something out of the market, right? Also operating in this is market maker algorithms facilitating business between small retail customers. I'm not talking about the market maker, the guy that takes the phone orders from the big business. I'm talking about the automated algorithms that are in place to just facilitate this business. When you guys click the button, the buy or sell button on the dealing platform, that's not going to a person that's approving that trade. The execution would take a lot longer if that were the case. It's going to a market maker matching algorithm that just does the small stuff automatically. If you guys are going to make bigger trades, like the hedge funds and things, you'd actually have to call that in because you wouldn't be able to put it through a dealing platform up to a certain size. So, okay, the characteristics of fast small money. It's a short-term approach to the market, usually under 1 day, like we kind of covered. They trade relatively low lots, do not have an overall individual impact on market price fluctuations. They're able to trade at market with almost no execution problems or slippage. For you guys that are newer to trading, what at market, what that means is basically when you click the button, you're not trying to make a market or get a specific price. You're just going to take whatever the best price is around where you want to get in. So most of us in the retail space are gonna trade at market because it's going to be good enough. And like I said, if you're not trading, $10,000 a pip, then you're not going to have any execution problems, and it'll just go into the market maker algorithm. So that's the characteristics of fast small money in general. Okay. So now we're going to talk about who is slow big money. This category includes institutional traders, money managers, hedge funds, and some well-funded retail traders who collectively make up the market moving class. Okay, their characteristics are a longer-term approach to speculation trading, usually days to months, regularly move large amounts of money in and out of the markets, must consider available liquidity before executing a trading plan. That's an important thing to think about. They have to consider money to get in, money to get out. And they also trade large enough positions to influence market movement, especially collectively. You're talking about the major banks that operate in the Forex markets. There's only a handful of them. So, collectively, they are definitely going to make up the big swings that you get intraday and on the weekly time frames. They're facilitating a lot of that, especially the big business transactions from businesses wanting to move money from different countries that they operate in, and even to some governments. They actually move money for governments as well. So they got their hands pretty deep in the whole thing, those big banks. So what category do you fall into? Okay, most people watching this video would fall into the fast small money category. Okay, so to truly learn how to trade, you must understand both categories. So what do I mean by understand both categories? You got to because you're operating as fast small money. Most retail traders are, because that's significant enough in that category as far as lot size and things. But you're in the ocean with these much bigger institutions. So you have to understand both these categories. So to accurately forecast future market movements, you need to think like the big slow money, even though you cannot individually move markets. Okay. Ultimately, to win at trading, you'll need to base your trades from where the bigger money is flowing, because the bigger money is what creates the actual moves. In order to go from point A to point B and have a price change, we need to forecast that. Okay. So that's why you have to get in tune with that. And also you need to know when the small fast money is about to be overcome by the bigger slower money, because the bigger slower money is going to always win, because they'll just absorb those little trades into where they're ultimately going to drive the market. Okay, so let's keep moving on here. So I apologize if I'm a little clunky, and this is the first time I've given this presentation, so trying to flow with it as best I can. So how does big slow money trade? So when trading huge amounts of money, traders do not have the ability to jump in and out of the market on a minute by minute basis. If you're trading big amounts of money, you're not looking at a 1 minute chart. Maybe if you're stacking a bunch of microtransactions to move an overall sum, then there may be some of that, but ultimately they're not. What I mean by this, they're not getting in with a huge amount of money and getting out 5 minutes later. It's not happening. Okay, if an institutional trader is working with large amounts of money, they risk moving the market too much at once and losing huge amounts of money on a single trade. They can't, when you're trading that much money, you can't show your hand all at once. You have to accumulate. You have to accumulate and you have to distribute. And that's ultimately what sustains those market movements. When you see the accumulation, trying to build a position, you see the market tiring out. They can do this in supply and demand zones, very commonly taught. And then they have to distribute the accumulation out over time, which is just a function of moving big money. You have to do it. You can't just be, in a billion and then out a billion and just jump in and out of the market. You can't do that. They actually have to worry about trading. They got to work those trades into the interbank market to actually get liquidity to pull that stuff off. So all trades must be planned in such a way as to follow to allow time for execution and the following liquidation of their positions at higher or lower prices. Again, I get ahead of myself because the slide always goes where I want it to go, but just reiterating what I just said, has to be planned out. They got to allow time for execution and the following liquidation of their positions at higher or lower prices. It takes time is the key, and we're talking about time frames. So I'm setting this up. Remember that it may seem like we're a little off track here, but we're talking about time frames. So if execution and then liquidation takes time, start thinking about that, okay? So these forces can be accurately classified and monitored through viewing the market through higher time frames. Again, 1 minute chart, 5 minute chart, 15-minute chart is not going to be enough time to move money for international business. Okay, so I'm not saying that those time frames don't react. You can be coming up to the high or define high or low on the hour or 4-hour chart, hit those highs or lows, and you may be watching a 1 minute chart and see a dramatic reversal. Well, it wasn't because someone saw the 1 minute chart, it's because they wanted to move some money because it hit a high or a low of that larger time frame. Or it was going towards a higher or low, and they just depends on what they were trying to do, or multiple institutions were trying to do. But it's going to be bet on where they know that they have enough time to fill the position and then close out the position if they need to, or however they're planning on working it. So, but anyway, like I said, it takes time for execution, and we follow time frames. So if big money is taking time, then it starts. Hopefully, you see where I'm going here with the higher time frames. Okay, examples of different time frame representations: the 1 minute, 5 minute. Again, mostly retail traders looking to capitalize on small market movements. It usually lasts no longer than 5 to 30 minutes on average. Talking about people looking for, they may be assessing like us, we assess the trend on the higher time frames, and then we can look to catch smaller moves, but we're trading in trend, always trading in trend, right? But these trades are typically going to be 5 to 30 minutes on average, and they're going to be in session, or they should be. You guys shouldn't be trading out of session, especially if you're trading the majors, anything associated with the euro or the dollar. You're going to want to be in the London, New York sessions to catch these kinds of moves. So the 15-minute and the 30-minute is mostly retail and some institutional traders looking to capitalize on daily swings. Most trades last from 30 minutes to several hours. In Forex, positions usually liquidated by the end of the New York session. So if you're trading a 15-minute, like a lot of you guys trade 15 into the 4-hour. That 15-minute position or even a 30-minute entry, that you're going to want to, if you open it in the session, you're going to want to have those trades closed out by the end of the session typically, because then you're going to go into the flat, the Asian markets where it gets really, really thin. So most people trading on those time frames are going to try to be at liquid by the end of the day, unless you're, I always tell people, unless you're significantly in the money on a trade, then you've kind of bought the right to sit through the Asian markets. But most people are going to try to be in and out, catch them out of the session, and that's going to be how they trade on those time frames. Okay, the hour, the 4 hour, and the daily is going to be more institutional traders looking for optimal trade placement for executing large trades. Also key in moving money for international business purposes. Again, the Amazons of the world, and the Walmarts, and the Costcos, and these big institutions, they do international business. They have to move money around, a lot of money. And they're going to need to, they still are going to employ traders to try to do that as safely as possible. And that can be key. That's why sometimes Forex is kind of known as the Wild West, where you get these rapid movements. It's because it's a utility for international business. It's not like a stock that is mostly built on speculation or people wanting to value invest in a company. They're looking for that company to appreciate. Forex fulfills a utility of international monetary exchange. So there may be people trying to move money just to fulfill that obligation for a client and not looking to trade. They're just looking to make a transaction, which can cause the increased crazy volatility, which we need to be aware of. But again, these are going to be represented in the higher time frames, because it's not a matter of clicking in and out on a button with a small lot size. It's a matter of moving money and trying to do that as safely as possible. Okay, the weekly and the monthly is going to represent the collective fundamental money flow of the market. Sensitive points provide opportunity for huge transactions on the interbank level. So the weekly, monthly, if you're looking for the fundamentals behind, you're looking for that backdrop behind your trading. That's why I always tell people, look at the monthly, look at the weekly, the very stable time frames to understand. I'm not saying don't look at the monthly, say the monthly's green, okay, I'm just going to go long. What I'm saying is, as you're trading through the weeks, through the days, you understand where the momentum is on the monthly level, then that can give you some key insight as things set up and push in that direction. And that will represent the fundamentals that are changing in those economies that are represented by the currency pair. So it's always good to have, at least in the back of your mind, understand where the weekly is, where the monthly is, where it is in the cycle with the 3 market phases, and it just gives you some deep insight into what the expectations are. So we're going to get more into that here in a minute. So, excuse me, how can you use this information to your advantage? So the biggest thing with multi-time frame analysis, or one of the big things, is it'll increase your win rate. By basing your initial analysis on the larger time frames, you align your strategy with those who move and control the market. Okay, that understanding where those big time frames are flowing relative to how you're trading. If you're trading in session, you're probably looking at the hour, 4 hour, or daily time frame to understand where the momentum of the day is and what the probabilities are. Though that's you're basing your smaller trades on that information. So let's take a look at an example here. We have a daily and an hour chart, right? And this is the exact same price action, just in different time frames. Exact same move. Okay, if we can clearly see that the daily money movers they're clearly driving prices up, defining a clear trend. We can see that this market is moving. Granted, this is already happening, but you can see even in the early stages, we started to see the momentum form on those daily bars. Okay, so on the 1 hour, the daily money movers the daily money movers are stronger than the hour money movers. So every short move potentially becomes a buying opportunity, and the reason is because if you think about it from a crowd perspective, think of the daily crowd as 1,000 people walking in one direction, okay, and the hour is 100 people, and they're all walking in the same direction. What you can think of is that every time, let's say they're all walking, they're all walking north. Okay, we'll use north and south, right? That 1,000 people is walking north, and then all of a sudden, 100 of those people at the front turn around, make a 180 degree turn, walk around, turn around and start walking south into the crowd. Okay. As long as the 900 people that are left over are probably going to overtake those people, and then the 100 are going to just turn and keep walking, and it'll fall back in line. So if you think of multi-time frames and analyzing that, especially in trend, you got to think of there's a bigger crowd represented by bigger, more powerful money moving, executing and liquidating those positions over time. And when those smaller time frames rotate against that, it could be a reversal because the daily has run out of gas or it's hit a high or a low. That is possible. But if the trend continues, which we're trying to always bet on the trend to increase our probabilities, our win rate, then we're betting on that the bigger crowd overtaking the smaller crowd. And this is, like I said, this is a big generalization, but I'm just trying to get you guys to understand this is one of the powers that comes with multi-time frames, as opposed to just looking at one chart and randomly trying to just jump in on the highs and the lows and draw lines of support and resistance. You can get lost on one chart, but the soundness you get from a higher time frame can give you an edge and keep you disciplined to one side of the market. And then you can set yourself up for having more winners than losers, right? So that's one of the things, is the increased win rate. Second thing, by understanding multiple time frames, is you get a better risk and reward ratio. By identifying more significant trending movements and turning points, you set yourself up to take advantage of potential low risk, high reward opportunities. Take another look at another example. We got a weekly chart here and an hour 4, same movement, right? Again, the week is much more powerful than the hour, or than the 4 hour. This means it could be used as a stable indicator for trend direction, providing you with your directional bias. You're only selling the market, right? So talking about better risk to reward ratio, if we can pinpoint the turning points in those markets based on our boxes, based on liquidity lines, based on the architecture that we have to work with, and we can at least test entries, when we actually get the trade and we stay disciplined to that trending direction, that's where the probabilities are that we can ride the winners. You know, everybody says cut losses and let the winners run. Well, this is how you do that. You do that in trend. That's a very old adage in trading. You want to cut losses and let winners run. You got to stay disciplined to the side of the prevailing trend. And in order to do that, you got to come up with an accurate understanding of, you know, where those higher time frames are headed. A lot of information comes out of there. So, okay, so now we're going to go to trade time expectation. So how long is a trade expected to last? By analyzing your higher time frame, you can more accurately forecast an expected time fulfillment to each opportunity. So let's look at an example here. If you have a daily, you're using the daily as your directional bias, and it's clearly telling you to only sell the market, okay? Then we have a situation right here where we have a contraction. You guys see a box and we get a counter trend expansion. And this is similar to what we teach in the basic strategy when you're first getting started with the software. Daily's going short. We're breaking out long out of a box, giving us that precise timing we're looking for. And then you see where the little red arrow pointed down is, the little red triangle. We try to enter on a rotation similar to that. What we're talking about is with multi-time frame analysis, you're using that daily as your chart to back this trade up, right? So that's going to give us a time expectation of follow through. Because the daily time frame must continue trending, the daily time frame has to continue, right? For this trade to work out, you can confidently say that the total opportunity from when you enter that trade shouldn't take more than a day or two to follow through and put you in the money. If we're expecting the trade to go short, right? And let's say, in this one, it went immediately. But let's say it starts to go sideways on you and you start to think, okay, is it going to go? Is it not? Well, you can look at your chart and you can kind of foresee and visualize what is that daily going to look like when this trade works out, and what's it going to look like if it doesn't work out, and how long could that potentially take? Well, a daily, if it's aggressively trending, even if you get a little pullback like this, is typically not going to take more than a day or two to rotate back in trend. So by understanding the higher time frame, you can assign time scales to how long you think you're going to have to be in a trade to actually get in the money. Same thing with a lot of one. I know that I had a problem with this when I first started trading a long time ago, but I would get frustrated trading the short time frames, and I would say, forget this. I'm just gonna look at the daily. Where's the daily going? Or I would say I'm gonna look at the weekly, and then I would just put in a trade. I was like, oh, the weekly's going up, and didn't time it or anything. Like I said, just a total rookie mistake. And a lot of people end up doing that, where they want to go to the more stable time frame, but they lose track of the time frame that they're dealing with. Yeah, the monthly and the weekly are more stable, but you got to remember, if you're basing a trade off the weekly, you can be sideways for weeks, even if it's a good trade. And people they click into a trade based off of, oh, I see an entry, but they lose track of how long the fulfillment and the follow through can actually take. So just keep that in mind when you do use the higher time frames for your directional bias, especially if you're trading like a 4-hour into a weekly. You got to remember, when you enter that 4-hour trade, you ultimately need the weekly to follow through in trend to get paid and for that trade to work out as a winner. But that, you can have 1 week that just goes sideways, and then the next week can start to trend, and then it'll be 3 weeks later that you finally get the big move you're looking for. And it can happen, within a day or two. It can't happen immediately. But understand that when you're using that higher time frame as your directional bias, you're kind of subject to the follow through according to that time frame. And you're just looking to stick your entry on the lower time frame. So, but just keep that in mind. That's another thing with the time expectation that you can get when looking at the higher time frames for your trend. So another one is expectation and preparation. Understanding what the different time scale trends are across different time frames will help you to focus on where the money flow is and plan accordingly. Short-term traders looking for smaller moves during the London-New York session can look to the daily and weekly for perspective. Okay, if you clearly understand the direction of the week, then you can be prepared for the majority of the big in-session moves to unfold in the same direction throughout the trading week. This is something that I emphasize when we used to do coaching calls with everyone that joined before we started doing the webinars. This is a big thing that I always drill down, is that they'd say, why do you want to look at the weekly? That's so big. I'm trading on a 15-minute. It's because if you understand the direction of the weekly, then Monday through Friday, if you clearly see the weekly is trending long, and you've done that analysis, and it's a general analysis, you don't have to be crazy on it. It's like it can be as simple as, what color is a weekly candle? If you understand that it has been trending the previous week, it's green, it's not overextended, and now you got the start of a new week, the candle opens green, maybe it's Monday, maybe it's Tuesday. What you can kind of plan for is that if that weekly trend keeps pushing, then the majority of the big moves intraday, those 15-minute entries that you guys look for, the ones that are in line with that weekly direction are probably going to pay out better. They're probably going to be smoother because they're in line with that overall fundamental trend. So by just having your mind kind of on that fact that the weekly's long or the weekly's short, when those opportunities that you're working in those intraday sessions, you may get an entry and it turns into a big old fish, and you just let it ride because you understand now, okay, the fundamental direction's kicking in. You nailed a good entry, and you have your mind on that. Whereas if you're not looking at the weekly and you don't have that in the back of your mind, what can end up happening is you can snag what can turn into a humongous trade. You're up 20 pips, really fast or whatever relative to that currency, and you're like, oh, I like a 20, I'm just going to take it. But if you knew, like, okay, this thing's rotating the weekly, or it's pushing the weekly, the daily's pushing, and you just understood where the momentum was on those higher time frames, you can really, again, let those winners run when it's appropriate. So longer term traders looking for bigger moves lasting multiple days or weeks can look to the monthly for perspective. Same concept. The current direction of the monthly chart will tell you where all the big money's flowing. By understanding this basic fact, you can anticipate massive opportunities that set up on the daily time frame in line with the monthly direction. Same exact thing I was just going through, but just if you're someone that can't trade intraday, can't trade London, New York, you're going to want to move to the 4-hour and daily time frames as your entry, and you're going to want to really have an intimate understanding of that monthly chart. Because that's going to be that's the fundamental direction that you want to be in line with. And when you see big corrections that don't pull the month around, those turn into big opportunities for you to look to scale into. So let's go into some tips here, because I know there's some things I just wanted to mention that I think can be helpful. This is something that I just want to address in general, is that regular candles can be a bit noisy. I know that I use those on the examples in here, because this is just, if you notice, it's just ATS general market training. This is going to go in a section in the course that's just general. Doesn't have a lot to do with our software, some to do with our methodology, but again, this is about multiple time frame analysis. So someone that's watching this that doesn't want to use our software, you don't have to use it if you don't want to, but you want the information to apply to just normal charts. Just a helpful tip is that you guys know that have been trading for a long time, normal candles can get very noisy. They get very, especially in consolidation, we call them contraction areas, very, very noisy. So that's why in ATS we use HA candles to smooth out the market, and it gives us a better defined trend. I know some of you guys, when they first get our software and they look, they say, why are the candles different? It's because of that. They give you a more stable understanding of the direction, and this minor difference in candles and the way that they paint and the way they hold color can be the difference between you holding a position or not. If you're looking at a higher time frame and you see that candle fluctuating too much, then it can cause you to dump what would otherwise be a good position. So that's why we use HA candles to stabilize the trend direction, and also they show a better overall swing of the 3 market phases. They just give you a cleaner look, because remember, we're not looking at the price per se, the individual tick by tick. We're looking at a general map. That's what ATS is all about. It's about looking at a general map of the market, and HA candles are better for doing that. So for those of you guys that don't know, I'm sure a lot of you do, the HA indicator normally comes in MT4 by default. If it's not in your MT4, it can be downloaded from the main MetaTrader website and installed manually. So those of you guys that ever want to use that, it's there. This is not proprietary to us. We use it as the default for our candle selection, but it's available. It's not our indicator, and it's out there for everybody to use that would find it helpful. Okay, another helpful tip: if you can't make sense of your higher time frame, stay out. This is a big thing we get a lot of emails about, is understanding this. I don't understand why the trades, I got in a trade and it keeps going back and forth on me. You're not looking at the whole thing as a bigger picture on your higher time frame. The higher time frame is what's going to pay you, and if it bites you, you need to step back. If you get in a trade that you feel is good and you take a loss, it's time to take a big step back and understand that bigger time frame. Give it more time, okay? Because a lot of times when we go into these sideways markets, most of the time when markets are unreadable, it means they're in the contraction phase on an even higher time frame. It means they're going sideways. If you're looking at a 4-hour and the 4-hour looks like this, then what it means is probably your weekly is probably a little tiny candle, and it's probably going sideways on the weekly, or it's headed into a box on the daily. So that can happen. It's just part of the market phases. But the quicker you identify that, the quicker you can step back, because this is, for lack of a better comparison, this is when the slot machine is accumulating. Okay, this is where if you walk in a casino and someone's just feeding and feeding and feeding a machine. I don't gamble. I know it's just a good analogy, so I apologize if I like to compare the market to gambling, but this is kind of the market's equivalent of that. The machine is just taking money. Someone's feeding it, and they get frustrated that it takes all their money, and then sure enough, the algorithm and the machine opens up to the payout cycle. Then that one person walks by, puts 1 quarter in, and hits a jackpot. The same thing is true with the market. That's that contraction phase on the higher time frames, on the smaller time frames, that's when the machine is taking the money in. Okay. And then after that is when the expansion is the trend is that's when it's allowed to pay out. And we're always trying to stick to that expansion phase because that's where not only the market becomes readable, but that's where the consistent follow through comes into play. And we need that follow through to do well over time. If you trade in markets that are sideways, I don't care what anyone says. If they say they make money in the ranges or I think over time you can't do well trading support and resistance at the same time, selling highs and buying lows, especially if you're doing both. Now, the contrary to that is you can buy support or sell resistance. If we're talking about it in general terms, you can do that, but only if you have a higher time frame supporting one direction. So if you, for instance, you're at a support or you have a pullback on a 1 hour chart, but you clearly see the weekly and the daily are trending in the same direction, then you would only, let's say it pulls back on the hour, the weekly and the daily are trending long, then you would only want to trade the upside of the range. You don't want to short the highs. And then vice versa. If the weekly and the daily are trending short, you'd only want to short the resistance. You'd only want to sell the highs. So, but you don't want to trade both sides. That's one of the things with multiple time frame analysis is you want to marry one side of the market because that's what allows you to roll the probabilities on your side. Yeah, you may take a few losers trying to find the winner, but ultimately that's what pays you. And then if you spot a trending market, something that's fresh out of a contraction, especially on the higher time frame, that's where you set up to knock them out of the park. And then when it gets crazy and goes sideways, if you don't understand the higher time frame and it looks, especially if it bites you and the higher time frame rotates against you, that's a sign to give it more time. Don't immediately get back in, get more information. And then when it starts opening up, that's when you start getting aggressive because you know you're getting into that payout cycle. So hopefully that tip helps you guys. So in conclusion, the facts are we need clearly defined trends to follow to make consistent gains over the long run. We need markets to move from A to B in an orderly fashion enough that we can understand, get low risk entries, and have the opportunities of letting winners run, right? We need those trends. We need to trade in them. So consistently profitable days come from trending weeks, backing them up. Weeks that start at point A, end at point B, right? We need those consistently profitable days will come from trending weeks. Those consistently profitable weeks come from trending months. Same thing, higher time frame. So if you stay disciplined to the trend long enough, then those weeks and months add up to a career. So that's what I got for you guys today. All right. So I've been talking for a long time. I have not paid any attention to the questions. So give me a minute to catch up on that. Let me pull up my other screen here. We'll look at a few markets if you guys want to. But let me read through the comments here and see if we got any questions to answer. Let me pull my other screen up here. Hang on. Okay, that's up. So, okay, guys, give me a second to catch up here. One moment. So one thing too I want to mention too before I get into this, I apologize too because we got so many people getting on this webinar now that so I start with the questions that come in first, and I work through those questions, and sometimes I'm not able to get to the last ones. So I apologize if I don't get to your question. Then you guys can always send those in to support@TradeATS, and we'll answer them that way when we get around to it. Usually we try to get them out within the day, or within that day that you send them, depending on the time. So anyway, just apologize if I don't get to your question, but I'll work through them as fast as I can. So hang on, just doing a little bit of reading here. Okay, here's a question. This question kind of actually goes into another email we were just answering. With brokers setting their timeframes on their candles. This is there is a minor variance that I want to mention. If you have, let's say you look.
Hey, Wade, I think you might have muted yourself on accident.
I muted myself on accident. Sorry. I don't know where it cut off, but I'll just start again. So we had a question about a broker, the time zones with the broker set on MetaTrader. So with MetaTrader, the brokers set when certain candles open and close. They have the master control over the time zone. So with ATS, the way that the algorithms are written, it's all very specific. Everybody has the same exact algorithm loaded into their platform. But the way that the data is collected through the platform and the way the brokers distribute the data can have minor differences. Overall, it should be very similar. But this can, because some of the algorithm does rely on the opens and close of candles, the colors of the candles that they open and close, you can get minor differences in the way that it reads. So if you, for instance, if you have the software loaded up on FX Choice, and then you have another broker like Blueberry Markets or IC Markets or Forex.com next to it, and you notice that a box is a little bit different position, or maybe a box didn't show up at a certain spot, that is because there's that minor difference. And this is something that we can't get around. The only way to totally get rid of that would be to make everybody trade on the same broker. Which isn't going to happen. It kind of defeats the purpose of running on MetaTrader 4 because it gives you guys the flexibility of trading with whoever you want to trade with. But understand there is that minor difference. It's unfixable because of the variances in data. Overall, though, even though there are these slight minor differences, because we look at the chart as an overall map, there should be enough information regardless, even if you're missing one component compared to someone else's. Everybody should still come to the same conclusion, even if your readout is slightly different. So, like I said, it's just something we can't get around. But they're overall, if you're doing this the way that we show you and you're using it, you should still have enough to work with on the screen to come to the same conclusion. Okay. So just wanted to put that there. And there is no disadvantage as far as the time frames with brokers or whatever. You could trade with it as long as it's a consistent data stream. You can use the broker that you like, as long as the most thing you need to worry about is if you feel comfortable with that broker and that they're reputable, so you can actually get your money out of the account if you want to withdraw. It's very important. So that's something that you guys need to evaluate. And we always push people. We don't have any IB relationships and don't make any revenue streams off of brokers with what we do. So we're unbiased in this. But I always push, if you're in the States, I just push people towards Forex.com. It's controlled by Gain Capital, big company, very stable. So that I think that they're a reputable place, especially if you're going to have a bunch of money sitting there. But there are some advantages to higher leverage offshore brokers and things like that. But again, there comes some risks with that you guys need to evaluate and make your own conclusion on. Okay, let me keep reading here. Okay, when when the weekly and daily are going opposite, which one is better to use trading the 15-minute? Okay, so if the weekly and daily are in opposite direction, if you're trading a 15-minute, then your initial look is going to be at the daily. But if your daily and your weekly are in an opposite direction, those timeframes are pretty close. And so that's showing you that there is some difference. Let's just put it this way. The daily operators, the daily market movers, are going to be very close to the weekly operators, as far as moving the market. So if you have that difference, what it means is that you're probably in a wide range, and that overall market condition you have to be careful in, because there's not enough confluence between those time frames. So if you're going to trade a 15-minute, you can definitely look at the daily as a direction of the day. Maybe mediate that with a 4-hour. So look at a 15, a 4-hour, and a daily. But if your daily is not in the same direction as a weekly, you need to just take that into account. I'm not saying you can't get in there and smash and grab a couple of trades, but let's just put it this way: I may not let it hang out as much as I would if they were in alignment. But you just need to understand that there's some differences in the big money pulling against each other at that point. So just something to keep in mind. Let me keep reading here. Let's see, I think we're getting some, I see some comments to look at some markets here. I'm going to try to answer the questions that are more pertaining to the PowerPoint. And then if we have some time, we're probably going to wrap it up probably here in about 15 minutes or so. We'd like to keep these around an hour if possible, but I'm going to try to answer the questions about the PowerPoint first, guys. And then if we have some time, we'll take a look at some stuff. Okay, here's a good question. The question is, do you ever supplement HA candles with an examination of price action on Japanese candlesticks for trying to pinpoint entries? I have done that. Here's the thing. I've been doing this a long time, so I can, I know how to weight certain things, and I've gotten bit before trying to compare too many things. And so what I recommend is that people keep it very simple. The best trades are usually something that it's setting up. You see it and it just looks clean. You understand it, and you get that sense of knowing, that sense of feeling that comes behind getting in a good trade. So one of the dangers of trying to compare, you got the Heikin Ashi candles running, then you're running a standard candle, Japanese candlestick next to the Heikin Ashi and trying to pinpoint, that can be a little bit of information overload. And remember, we're trying to do less trades and higher quality trades. So that's really the name of the game. You want to trade as little as possible, but you want to trade in the most favorable situation as possible. So that I think that could be detrimental if it's something that works for you and you find an edge for it, and you don't find that you're making more trading decisions and it's causing you to overtrade or see things that you're causing you to change your opinion more often. If it helps you, then go ahead and do it. But I probably wouldn't recommend, especially someone new, to complicate the screen anymore. With ATS, we've put on, there's a tremendous amount of information on the screen, but our goal is to not overwhelm. We want you to see price action and meaningful price action in trend. That's it. Those two things is all you need. So sometimes adding indicators and adding extra criteria just is what you're really looking for. Is you're looking for an excuse to trade more. And if you're looking for more action, that this is probably, you're probably not going to have a great experience. Trading shouldn't be, it's fun. Don't get me wrong. I love it. But if you're having a lot of fun doing it, you're probably losing money. And yeah, you could have a blast in a casino too. But it should overall be pretty boring. And the setups, when they're right, you should understand what you're doing. It should be quantified with your risk. You shouldn't be over leveraging, and you should be off to the races in those trades that you understand. So What we're going to put on the screen is what we think is no more than what you need. We will only put something on there if it shows it's significantly meaningful in helping you trade maybe even less. Less trades, higher quality. That's the name of the game. One thing I want to mention too, real quick, is that some of you guys, and it's kind of heartbreaking to see this happen, but and it's just kind of part of the nature of the industry. But people come onto the system every once in a while. It doesn't happen very often, but they come onto the system, and I don't think it's just ours, but it's whatever they try, and they'll come on with a big account, relative to what they can afford to trade with, and they start trading on our signals or on whatever they're doing and trading super high leverage. And we've had some recent, well, just one that in particular I'm thinking of. I'm not going to mention any names or anything, but someone came on and said, I've been trading and I'm down 30% of my account. And at this point, they'd been on the platform 8 days. And in that 8 days, we had a weekend and non-farm payroll and the rate decision. We had these significant news announcements coming up, which makes for a very volatile thing. So what I want to encourage you guys to do, regardless of what you're doing, that obviously this person was aching to have a bad experience, because that's what that's going to do. If you're down that much in your account, trading in that volatile of an environment, especially with the consolidations that come up to those news announcements, and you're on a new system, a new way of thinking, and you have that little experience, you don't have any business trading something that you can't be unemotional with. And maybe, I don't know the situation of this individual, maybe they had tons of money to burn and they don't really care, it's fun for them. But in general, I know a lot of people that get into trading, it's like they really need to make a go of it, and you have to start safe, so you have to start small. There should be no situation where on whatever system that you're using, regardless if it's ours, our software or whatever, where you should put yourself in a position to get killed that much in that short of time. Whatever you're doing is going to take time for you to learn how to roll with it mentally, and get the sense and the feel that you need to operate in it. So, if you guys are new to this, make sure you start small. I know it's boring. I know it's not exciting, but we don't want dead bodies. We really want this to be a help to you, but you have to give it the time you need to understand how to feel it. And you just go to the basic trading, to the concept. It's not new knowledge. Don't risk more than 1% of your capital on trading, on any one position. That'll keep you in the game a really long time. If you go through some sideways contraction periods, you get a little bit beat up. You don't know how to spot those quite as fast. You will over time, but the lessons don't need to be that expensive. You don't need to get such a significant shark bite, what we normally call it, where you can't even come back and play the game. So give your guys that flexibility. We don't, like I said, we don't want dead bodies. I know that some people won't be able to help themselves, but we want you guys to be safe.
I just wanted to add into that real quick. It wasn't in 6 days his account was down that much. He went into a trade right as he was in a trade in a position right before rate decision got released, and he rode through it without any stop and was down 30% in that one trade, and then was, obviously that was our fault, I guess.
Yeah, so that again, you guys are going to make the decisions of the trades that you pull. That ultimately you guys are grown people and you're going to have to do that. But man, we hear something, like I said, it's pretty rare. We try to get people on the right track, but man, it's just like, why, you don't have to do things like that to, especially riding something with no stop and no quantifiable risk. It's just, anyway, we don't need to beat that dead horse. I just want you guys to be safe. All right. So let me keep reading. We're going to try to get to a few more questions. So like I said, I apologize if I can't get to everything. But like I said, you guys can always send your questions to support@tradeats.com and we'll be happy to work with you there. Okay, hang on one sec. Okay, so one thing I want to mention, I see that because I know some of you guys are gonna have contrary opinions, thinking that the smaller time frames control the larger time frames. They may have some play into that, but overall for momentum, remember, we're momentum traders. We're looking for a move that's already started. So if something is going sideways, it can become very convoluted. There's a comment here saying that uh, the gold market, gold against the dollar, what we're looking at right now is swimming sideways back and forth. So it feels like the hour and the 4 hour are controlling the daily moves. And that's just because overall the market is still, it's just swimming sideways. In a situation where you can't make sense of that, of your supporting time frame, and especially if it bites you, then what you got to do is you got to zoom out. You got to go back, go to a higher time frame and figure out where is the trend. We need, at the end of the day, going back to the PowerPoint presentation, you need a trend. And if there's no clearly definable trend, and I know that trends are going to be after the fact, so you're going to have to eventually stick a position. And that's the best thing to do is at the beginning of what you feel like is a rotation, something happening in trend. That's where you want to get a little more aggressive. But if you can't stick it and it falls apart on you, you got to back off. You got to zoom out, and you got to figure out what the overall sentiment is. So on in the gold market right now, overall we're kind of having these weeks that are kind of pushing down. So let's take a look at the month. We got a red candle on the month, very first one. So we are in the turn of the monthly time frame. So the fact that this is the very first candle, shows that there's a big decision happening fundamentally. So it can feel like the 1 hour and the 4 hour are pulling around the bigger time frames, but the facts are is that your bigger time frames have indecision. So they are still in control. Okay? The monthly market movers are trying to figure out what the next move is going to be. Where can they push the market for liquidity? I think that there's a good chance if we rotate green, we're coming back up to this expansion level right here. I think there's a good chance, but again, this is a monthly time scale. How many candles need to stack to get there? It could be 1, it could be 10. So, but anyway, that's what's ending up happening, and that's why the gold trade has been so back and forth, is because you have indecision in your higher time frames. So understand where you are. Again, multiple time frame analysis. First red candle on the monthly, big significant turn, you're going to have a lot of whips back and forth. And that's because the big money is still controlling the little money. And that's just what happens when there's that indecision. So let me keep reading here. Hang on. Okay, now I'm getting to the questions. When I started talking about brokers, people asking what's a good broker. Guys, just do your own research on brokers. We're not I'm try not to be a spokesman for the brokers. We're not in it for a lot of people. What you guys got to be careful with is in the Forex is a lot of people that tout strategies and stuff. They don't really care what you trade because they want you to trade. They're usually have an introducing broker relationship with a broker of their choice that they push you towards, and their goal is to get you to trade as big a money as possible as frequently as possible because they get a part of your spread. Okay, guys, we don't get any of that. Our interests are for you to be safe. We want you to be on ATS forever. That's our goal. I know it's not going to work for everybody. We don't expect it to, but the people that get it, we want you to be on forever. And the only way you're going to trade with us forever is if you don't blow up. Okay. So, our goals are not aligned with brokers. We're not going to be making big recommendations on certain brokers. The only difference to that, I talked to Shane about that, is that if we did have a reputable broker, we wouldn't take a commission from your trading. We don't want the conflict of interest. We want you guys to trade safe, make trades that make sense to you. So we're going to take that off the table. But what we may do in the future, depending on if the broker would have to be absolutely spotless, and we'd have to do more research. But if we can work out a group discount so that we can get you guys better commission prices instead of them paying us, we'll just pass it down to you guys. So we get a group rate. We may do that. And we have been getting approached by brokers to because they obviously want our customer base. We got quite a few of you guys. So they're like, we get hit up all the time with people that want let us advertise to you, recommend us. You can make all this spread money. We're not doing it. Like I said, our interest is in your guys being safe and doing that. So, but like I said, in the future we may work out a recommendation, but only because we can pass on the savings directly to you guys, because then that's another value add by being part of the ATS community, that you guys get extremely amazing commission prices, even if you have smaller accounts, because typically you need a big account to get those breaks. So that would be something that we would want to help you guys with. But again, the broker, it's a shaky business. In the meantime, you guys got to do your own research, trade with someone you feel comfortable with. Like I said, we like to use forex.com just because they're regulated, and they're big. So, I mean, that's, I think if you're running any reasonably big amount of money, that's a good option. But again, you guys got to make sure that you do your research. Okay, let me keep reading here. We're going to wrap it up pretty quick. I'm going to try to do a few more questions, and then we'll go ahead and wrap it up. So hang on. Okay, great question. Follow up to the one comment made about the gold and the smaller time frames appearing like they're controlling the bigger time frames. If you see that indecision on the higher time frames, should you go to a different pair? Now here's where there's a slippery slope here. I will kind of beat the drum. I do beat the drum that I think you guys should stick to one or two pairs. And when your higher time frames are showing indecision, you go on vacation. Especially if you're trading the daily sessions, New York, London and New York, and the daily goes in a box. Those are days that you shouldn't go to work. And I know you can get breakouts. I know there may be trades, but as a general rule of thumb, remember, you don't want to be playing the slot machine when it's taking money. You want to play it right as it starts to distribute the money it's collected. And that is the equivalent of the expansion phase leading into the trend, whether immediately or after a few legs. So If you understand that timing, that's when you want to get aggressive. If you guys set up the ATS assistant on your pairs, your 1 or 2 pairs, and you're trading the daily New York sessions looking for those 15-minute swings, set up the ATS assistant with the box expansion signal on there, and then when you get that first breakout, what that means is the next 3, 4, 5 days, week, 2 weeks, you can get very tradable trending days in general. They may not all be, but you understand you're entering that phase on the market, and that's where you can potentially start to get a little more aggressive and get days that actually have significant movement. Again, that's timing volatility. So when you guys, if you, going back to the question, if you look too much at too many different pairs and you make a habit of that, if you're the pair you're trading is in a, it's just like gold, it's, you got indecision on the monthly, you don't have a clear defined candle direction, you may want to look at your other pair. If you have 2 pairs, maybe 3 pairs you're looking at, but as a rule of thumb, what I don't want to have happen is for you guys to jump between so many different pairs. What ends up happening is that you never develop the intuitive sense that you can get on 1 or 2 pairs, because you just are kind of casting your attention on a bunch of different things. So I find my opinion, you could do whatever you want, but my opinion is ride with the cycles of that pair. Even if you're trading gold, right now it has been more of a difficult trade. There's been some opportunities in there, not on the long term. For the daily, the daily swing traders, it's been more difficult. It's been pretty sideways, but there has been some good moves in the New York London sessions on gold, which you could have paced together some decent days. But what I don't want to have happen is that you guys get frustrated, go look at something else, and then by the time you go look at something else that's trending, that goes now into the contraction phase, and the pair that you were rolling with, that you had the sense for, starts moving, and you now miss the perfect opportunity to start going heavy. That gets really frustrating. So if you guys look at it from the long-term perspective, remember what we said in the end of the PowerPoint presentation. Trending weeks turn into trending months, and trending days are powered by trending weeks. So if you just look at it, trying to buy and sell the long and short trends even from a weekly basis, weeks that are in the box, you don't trade. When weeks break out of the box, that tells you that the potential of you making a significant price change, whether long or short, over the coming weeks goes up. That chance of actually having trending days. So if you are ignoring the weeks that are sideways to the best of your ability and trading weeks that actually have a 100, 200, 300 pip potential movement, now you can start having probability to get into trades that actually go somewhere. And so now you're laying your cards out on the table when you got that in your favor. So by rolling with those 1 or 2 pairs, you have much better chance of being there right at the beginning. And then you'll get an intuitive sense when it starts to run out of gas. You see a big move is gone, you start scaling back on your intensity. You let it go in because you know that box is coming. That box, that sideways market, you let all the other traders flood the market that saw the trend that you already got, let them get in, let the whole market go into the accumulation contraction phase. You stay out, get some boxes, let it get ugly, let it go sideways. And when you spot that, now it's time to start getting interested, because you know it's going to open up and that machine's going to start paying out. When you see that price action open up, now it's time to start getting a little heavier. So okay, let me see. I'm going to do one more question here if I can find one. Hang on. Okay, comment about slippage. I know we were talking about, bigger positions having slippage. You guys got to also understand that slippage can sometimes come from your internet connection itself. So it just, you guys that are trading on Wi-Fi and stuff like that, there can be a slight delay in that. And also if you're trading during heavy news announcements, there definitely is a possibility, of getting late execution, not because there isn't liquidity. There's just, most of the time it comes down to your internet connection can have some effect on that. Okay, let me see there, maybe one more. Okay, I think that about does it. I'm just going to take a quick look at dollar CAD just because that's one most everyone follows. Let's just take a look. Remember, guys, we're coming up to the end of the year here. Trends are going to set up. We're kind of in an overall contraction phase. Even on, you can see the dollar CAD on the monthly time frame. Definitely have a short bias. It's holding under expansion. Sorry, my platform froze here. Hang on. While talking till it loads here. So on the monthly on dollar CAD, we're holding under that expansion. So the monthly, the days and the weeks that fall in line with that, those red candles, I would pay more attention to. But as a rule of thumb, you guys are probably, there very well may be opportunity all the way up till the new year. I can't, that's Forex, that's the markets. But as a rule of thumb, trading for a lot of years, it seems like it does get a little bit slow. So what I would use this time for is study. I would go back, look at charts, use this time to build your own knowledge, read some books. I know some books that you guys can get really good insights from are the Market Wizards books by Jack Schwager. Great insight. I don't agree with every insight in there, but you're talking guys that are, have a lot of experience in just the way they think about markets, even though they come from markets that were a bit different, talking the 70s and 80s, but a lot of the things they talk about from a mindset point of view are very relative to today even. So, I would use this time to invest in yourself, invest in your knowledge, and just study and try to lay off as much as you can until the new year. Let the new trends set up on the monthly chart. I would say right now dollar CAD looks like it'll probably be a good play come on January if we hold below that expansion over here. We hold below here. I'd say we may get to this low and it may reverse, but once we get to the low right here of this previous down series of candles, I'd say there's a good chance that we can have some nice trending months and subsequent trending weeks and days coming down to this level here. So I would be on the lookout for that, and should get some smooth movement. Ultimately, if you look at relative to these months right here, coming out of 2012, these are the markets that you really live for. It's unfortunate that people decide that they want to trade and they're not understanding the overall economic swings, and they're not understanding how markets have the potential to really open up. So if someone literally gets introduced to trading right here, these months, if they don't understand that the markets go through these phases on the higher time frames, they're going to have a really bad experience. It'll be very difficult for a new trader to make any kind of consistent gains in this. It's hilarious. It's not funny, but I mean it's kind of funny that like on weeks that I know, especially in dollar CAD, that are difficult weeks, we tend to get more people that unsubscribe. And it's because they don't have a longer term view, and and if they don't find value, they can't get it. No problem. They don't have to use our software. It's up to them. But we do get more people that quit, essentially, or at least quit on our program because they say this doesn't work, and it's because they've been trading in the course of weeks that are in a box on a higher time frame or fresh out of a box or just showing indecision. But ultimately, guys, you're trying to survive and make some profits. You're trying to survive through these choppy markets so that you can be here when this happens. It's a question of being here to play the game and not blowing up. It's a question of survival. So you can take advantage to be there when it's clear as day. And the only way you guys can do that is by managing your capital and being safe and having a long-term mindset. During months like this, the days are unbelievable. You show up and it's just nothing but a huge trending day. So in order to see things like that, you guys got to be around. And like I said, it's unfortunate if you get introduced to trading and you say, I've been trading for 3 months and I've been only trading dollar CAD. Well, it's probably been a pretty reasonably difficult 3 months. But guess what? The light at the end of the tunnel isn't a train, it's volatility. The markets will move again, and they will move like this again. They always will. There's always going to be another trade, but you got to protect yourself up until that point so you can actually play the game. So anyway, guys, I'm going to leave it at that. Again, we're not going to have webinars this next week or the following week, but we are working on the new content, the stuff that I've been previewing with you guys for the PowerPoints we've been working on. We're going to do some minor tweaks to those, and then I'm going to record all of them in a final cut and put those in the online course. I'm hoping to have those uploaded probably with some additional ones that I haven't previewed with you guys. First week in January, we will send out an email. And again, I did get the latest version of the expansion index, which again is super cool. If you guys didn't see the webinar last week, I encourage you to go watch the replay. I am doing some final testing with that, making sure it's good. So we're hoping to have that out to you guys probably first week in January as well. So anyway, January should be a pretty meaningful month as far as getting some of this new stuff out to you guys and getting you up and running with that. So, and then we got a lot of cool stuff planned for next year in general. So anyway, I appreciate you guys, especially you guys that are toughing it out through some of the difficult markets, the committed ones. Man, we're super happy to have you guys, happy to have everyone, but especially you guys that are toughing it out, looking at the long distance race that this actually is. Really appreciate you guys, and we're happy to be working with you. So I'm going to leave it at that. Everyone have a great day, afternoon, night, wherever you are in the world. And we will see you guys in 2 weeks for the webinar. And we'll get into the next new year. So everyone have a great time off, and we'll catch up with you guys soon. All right. Bye-bye.